Hi, my name is Alex Carlucci with Gus & Show Associates. I wanted to talk about 10-year notes because it's one of the most popular searches on Google, and our business, mortgage brokers, bankers, rely on this 10-year note to give us an idea which way interest rates are going. So I want to explain what a 10-year note is to you. So I used to be a trader, so I used to trade 10-year notes. So a 10-year note is designed by the government to borrow money from people or institutions or other countries at an interest rate that the government's paying, paying you back for lending the government money. So the government wants to build a freeway system. They don't have the cash, they'll go out and borrow it from the public. So they'll borrow $1 trillion and they'll pay everybody back at the interest rate that the 10-year note is paying. Right now it's 1.3%. So if you're a really, really successful trader, investor, and you have a portfolio of stocks, bonds, which is a 10-year note is a bond, and cash, you always want to have like 60% stocks, 30% bonds, and 10% cash. Well, with the interest rates being so low, I don't know if people's portfolio looks like that anymore, because earning 1.3% on money isn't such a great thing. It's become more of a parking lot for money for very wealthy people because it's safe, it's guaranteed by the US government. So when you got $1 trillion, if you're a big bank and you got $1 trillion of money that you got to park somewhere temporarily and put it back somewhere else the next day, you would put it in the bonds because it's safe. You might pay some exchange fees, but it's safe there. It's better than leaving it in a bank, because if the bank gets hacked, the bank only insures up so much. So it's used as a parking lot more so than it is an investment tool right now. Now in the past, the treasuries have been 6, 7, 8%, so it was a good investment to put your money in a bond. If you're retired and living on fixed income, it's a great way for older people to live on a good, safe interest rate that pays them money. But at this price, it's no good, but it's a safe place for people to put money. China owns a lot of our treasuries. There's 2-year notes, 5-year notes, 10-year notes, and 30-year notes, but the 10-year is the most popular. So the reason the 10-year note is so important to us is because our interest rates will trail that. So if you see the 10-year note yield going up, then that means our mortgage rates are going up. Not always, because we don't actually price off of a 10-year note. We price off a mortgage-backed security. But the mortgage-backed securities and the 10-year notes move pretty similarly. But if the 10-year note might go up because there's inflation, but the mortgage-backed security is going down because no one's locking loans and there's no demand for mortgages, those actually rates could go down. So there could be a disconnect sometimes. So keep that in mind. We don't follow the 10-year note tick for tick in our rates, but it's a great gauge for mortgage brokers. That's why I'm checking that thing all day long. Mortgage-backed security is a little more complicated tool to look at and figure things out. 10-year notes, nice and simple. Bam, looks like rates are going up today. Looks like rates are going down. You can chart them. You can kind of get a feel. Listen to, the news. They talk about the 10-year notes and what they think where they're going to go. So when they talk about tapering in the news right now, they talk about not buying those 10-year notes, and they talk about not buying the treasuries, which when they buy them, it drives the rates down on both of them. So when someone buys a 10-year note, the yield goes down. The more people are buying them because it's driving the price down. It's going to pay less and less the more there's demand. So as people sell these treasuries and get out, and they don't want to lend the government any of their money, the rates will go higher until it attracts someone to buy it. And the same kind of with the mortgage-backed securities. So that's why we look at these, and that's why tapering would be bad if they stop the tapering, or they stop buying mortgage-backs and bonds. It would drive interest rates higher. So when they say that it's time to taper, which means stop buying them, rates should go higher. Now, someone could come in and buy them because they think there's a market risk. So if someone would sell all their stocks, they might park that money in the bonds and buy them and drive the rates back down. There could be some kind of tug of war between the stock market and the treasuries, even if they decide to taper. I don't know what's going to happen. I mean, these interest rates are awfully low. This is a great time to get a house or refinance. So if that made any sense to you, you got any questions, I'll answer your questions, but that's what a 10-year note is in a nutshell. If you have any questions, my phone number is 630-915-7550, and please subscribe.